Is real estate really insulated against losses? Call it influence peddling of the real estate stakeholders, or a thought process that is culturally ingrained in the minds of the Indians. But the collective consciousness is made to believe that real estate investments are insulated against losses. I believe it's time to question the rationale. I am Ravi Sinha, and I have often been skeptical with the fact that real estate as an asset class has been oversold with the promise that you can never suffer losses with a physical asset, unlike stocks and mutual funds where an investor can suffer huge losses. To top it all, there is a general belief that real estate offers the best return on investment. A bullish real estate cycle every now and then is often cited as the empirical evidence, but real estate in the long term has hardly given better returns than any other investment products. This is even more true for the vast majority of apartment buyers, even if one discounts the depreciation factor. But wait, if you don't subscribe that it offers the best ROI, then you would be impressed to bet for safety. It's true that the market crash or wrong selection of stocks and mutual funds can erode wealth completely, and hence, generation wise possession of physical assets has been encouraged, including gold and real estate. But the age old wisdom was true in the good old age only, when property meant landed property and gold did not have as much risk of being stolen. The financial assets at that point of time was all about bank fixed deposits or national saving certificates. But it is imperative to note that during those good old days, the FDs and NSCs were giving returns in the range of 13.5 to 14%. In the early 90s, bank interest rates were in the range of 14 to 18%. In the late 80s, advertisements from nationalized banks said money would double in 5 years, 4.5 years. These claims were reasonably common. It's only after 1998 that interest rate went below 10% and gradually this became the Indian reality. So even during those days, property was not offering the best ROI. Now coming to the risk profile, real estate being less volatile does not mean less risky. Had there been a 0% chance of loss, then everybody would have been investing in real estate only. And yet people still come out with expression like you can't lose with property. Ask someone having invested in the Lavasa project and you would come to know how property investment could change the fortunes for all the wrong reasons. Here are I'm giving you a few realistic scenarios where real estate investment can also get into losses. Risk number one, what if the builder defaulted? No, RERA is not a guarantee that builder won't default. We don't have a legal framework where the preventive mechanism checks such defaults. Risk number two, what if the project is delayed? Even if NCLT coming into the picture, if a project is delayed for few years, your ROI is lower than inflation and hence it's a loss-making proposition. Risk number three, what if you did not get the project delivered? What about projects not being cash positive to be completed even after court intervention? We have seen many such instances all around. Risk number four, what if the project has inherent flaws that result in no appreciation or lesser appreciation than rate of inflation? It could also lead to faster depreciation due to the project's poor quality. The myth of long holding also fails in such a case. Risk number five, there are also interest rate risks and interest rates can go up anytime during the course of long tenure of EMI settlement. In such a scenario, ROI is lesser than the amount paid. Risk number 6. What if a buyer is forced into distress exit? It is no different than any other financial asset. If with a financial product the market could be in a down cycle, so is with real estate. Add to it the developer's arbitrary demands when you want to exit, like exit penalty or transfer charges, and one suffers huge losses. Risk number 7. If the investment is for the purpose of rental returns, an unoccupied building with no tenant is a risk to consider. Add to it issues with tenants such as non-payment of rent, property damage, or vacancies can reduce income and profitability. Risk number 8. If it is a landed property, then the title claims or illegal encroachment could also pose a threat to the investment. Risk number 9. Now, with the removal of indexation benefits with long-term capital gains, taxation is also a risk. Any future taxation risk can also not be ruled out. So, taken together, all these risks, all these critical factors into play, real estate could also lead to losses if one calculates the opportunity cost of money. Real estate returns have to be calculated both in terms of inflation adjusted as well as the borrowing cost adjusted. The advocates of real estate investment only talk about absolute returns, which appears to be mouth-watering. So, a property that doubles its value in 10 years may appear to be an attractive investment. Say, for instance, a property worth 1 crore becomes 2 crore in 10 years, but it has actually given a return of a CAGR return of only 7.2%. Empirical evidence from the 2000 dot-com bubble burst to 2008 Lehman crisis clearly suggests real estate could chain you for years if you wish to cut the losses. With real estate, only risk insulation is for the builders and the banks, not for the buyers. Risk-free real estate investment is hence something that is propagated by vested interests like builders and banks. No investment is risk-free and real estate is no exception. Hope I have cleared the myth. Thanks for watching.